Okay, good evening, everyone, and welcome to Coho BC's Collaborative Real Estate Investment and Financial Considerations of Co-Ownership. We're really excited to have three fantastic speakers here with us today with different expertise and different experiences in co-ownership of real estate, both personal and professional, and both housing for themselves and investment in others or with others. So it's going to be a really interesting session. Our guests tonight are Mark Ting, Stephen Jagger, and Richard Bell, and we really thank you guys for being with us tonight. My name is Noam Dolgan, and I'm also joined by David Hale and Brian Horowitz, two members of the Coho BC community, real estate agents specializing in co-ownership, and we're delighted to be with you all today. Before we get too deep in, it's important to acknowledge that there is a long history of land stewardship on this land in this province, and that when we talk about issues of land ownership and land stewardship, we do it with deep consciousness of the historic ties and relationship that many peoples have and have had with this land for a very long time, and we're thankful to be able to operate on this land and for their years of stewardship, and to acknowledge that going forward, and that's a complicated issue when it comes to land and land ownership. So what is Coho BC? That brings us here together today, especially if you're new. Coho BC is an initiative that works to promote co-ownership as a viable and valuable housing option across the province, to provide resources and professional support to assist groups going through the co-ownership process, to assist in the creation of co-ownership groups through a dating pool, so a chance to meet other like-minded individuals or families to create co-buying groups, and to help facilitate the resale of shared property interests to other potential buyers and partners. We are a collection of professionals, realtors such as myself, David, and Brian, lawyers such as Richard, builders, financial institutions, architects, mediators, all people with experience and expertise in collective housing, co-ownership, and really to support people going through this process so they don't have to reinvent the wheel. They can use the experts and set themselves up for success. While we are a uniquely BC initiative, this is part of a large and growing international movement. Here are just a few of the organizations that have popped up around Canada, the US, Australia, England, all places where real estate prices are growing, and people are feeling more and more of a sense of social isolation and are looking at co-ownership as a pathway forward. So who am I? My name is Noam Dolgan. I'm a realtor here in Vancouver and across Metro Vancouver, specializing in co-ownership, sustainable living, green homes, real homes for real people. And I just like to think outside the box real estate thinking. We're joined today by Brian Horowitz. Brian, why don't you introduce yourself?
Hi, everyone. Good to be here tonight. It's a pleasure to be here with you all, discuss this integral component of co-owning real estate. Working here on Vancouver Island in the Cowichan Valley. It's really exciting to find a different route to provide secure and more affordable housing to people who are struggling to create such forms of home ownership. Pleasure to be here and looking forward to everyone speak this evening.
Thank you. And also David Hale out of who hails out of Victoria. David, good evening.
Hail, hail, the gang's all here. Yeah, good to be here tonight. Thanks, everyone, for taking the time to be on. I just want to acknowledge you all. This is the wave of the future. That's what I believe. The only way that people in the future, especially young people, are going to be able to afford a home is to double, triple, quadruple their wages. And I think we all know that that's not going to happen. So this is a real interesting model. And it's really, like I say, it's the wave of the future, and it's just going to be more and more common. So I'm excited to hear what our speakers have for us tonight, and glad to be here. Thanks, Noam, for putting this all together.
Thank you. So why do people come to co-ownership? I mean, there are many advantages to co-ownership, and everyone has their own personal reasons, but the biggest draws are to get more for your money, to build community and mutual support systems, to access otherwise unavailable locations, and to know your neighbors before you buy. When it comes to co-investment, there's also a big focus. We'll certainly get more for your money, and have, you know, good support through partners who can be there either for you or with you, or share the load with you. Again, afford units you couldn't otherwise afford by working together, to not just buy an expensive, 1-bedroom condo, but come together to afford housing. And we also see a lot of times people investing in their friends and family, really, just helping support people who they know to get them into the market. Who do we see co-own? We see really every different demographic has different reasons and why they come in, type of housing types they get, but we see people in all groups coming together for this. Intergenerational families, young families teaming up, first-time home buyers, downsizers and older adults, people looking to live collectively. And again, investors do it for a variety of reasons, right? You do it to access the market and get in. You do it to support other people. You do it to diversify your portfolio. So we really like to think this is a good model for anyone who can think collaboratively and outside the box, and who can have the patience to do the right due diligence to set themselves up for what can be a much more effective investment strategy. It's actually more popular than most people think, as David Hale was saying. Recent surveys put about 50% of Canadians open to co-ownership, more with the younger generations than with the older ones. But it's definitely something that people have realized can work for them. So there is much more about co-ownership, and we encourage people to attend the "What is co-ownership and how can it work for me" intro presentation. Our next one is scheduled for November 20th. If you haven't done it before, or if you're new to Coho, you will get a link, a welcome email with a link to a previous session. So please do follow that, where we go for more than an hour into the details of how it works, the legal structure, the financial opportunities, the types of housing that are out there, what the process looks like, and much more. But you're not here today to hear from me. You're here today to hear from our fantastic guest speakers, Mark Ting of Foundation Wealth, Stephen Jagger of Addy Invest, and Richard Bell of Bell Alliance. So again, thank you all for being here today. And without further ado, I will bring up our first guest, Mark Ting of Foundation Wealth, who you may know from his regular contributions on CBC. And he's not just a financial planner and expert, he is also a co-investor in a property himself. So Mark, thanks for being here. And why don't you tell us a little bit about your story, and as a financial planner, how you see co-investment as an exciting pathway for people, and also what concerns or considerations do you feel like people need to think about before jumping into this form of investment? Thank you.
Yeah, sure. Glad to be here. Thanks for having me. My story started probably around 7 or 8 years ago. I had a friend of mine who's a realtor approach me, and he said, "Hey, Mark, can you help this family out? They're really struggling." So their story was that I think they were from Abbotsford, and they were commuting 3 hours twice a day. So like 6 hours was wasted in a car, because essentially one of the parents worked at the Port of Vancouver, the other one was a teacher in Surrey, and then they had a special needs child who was in Richmond. So it was just a logistical nightmare trying to figure all this out. They had a beautiful house in Abbotsford, but 6 hours a day was a lot to take. And they came to the Lower Mainland. They weren't picky at all. They wanted something somewhat central, but they, what they could sell from Abbotsford just really didn't translate into the Lower Mainland. So he asked me what I could do, and I was like, there's not really much I can do. I mean, the market is the market. And then he said, well, there's this place that we're looking at, and I think it's an amazing property. And to give you a little bit of a backstory, this realtor and I have co-owned other properties or invested in other properties ourselves. So I had a lot of trust in his decision-making and his instincts. So essentially what it was a property that was a fourplex. So right off the bat, I got interested because a fourplex, from my perspective, is a very flexible type of unit structure. There's so many different groups that can take advantage of a fourplex. And it was 2 3-bedrooms upstairs and 2 1.5 bedrooms downstairs, kind of like a bedroom and a den. So again, really like that 3 and 2 from a revenue perspective, so much flexibility. So I was actually intrigued, not so much by this family and their story, but I was actually intrigued first off by this property that he was planning on showing them. I was like, hey, I'll just tag along for this showing. I wasn't really planning on buying it. I just sort of wanted to see the structure because this whole thing was going for less than $1 million. I think it was for sale in New West for $960,000, which again, that price point was something I was it caught my attention, we'll just say. So anyways, I went there and I met the family. I saw that they're really good people, heard their story, looked at the place, and the place from the get-go was something that was sort of up my alleyway. It was definitely not turnkey. In fact, the listing said, sold as is, no inspections, cannot enter the building, like all these caveats. And in my mind, I was thinking, this is perfect because this will scare away 99% of people. Like it was like, Halloween's coming up. It was probably the scariest house there. So eventually we were sort of talking about it. And the father in this family was a very handy person. He worked at the port, sort of, doing handy maintenance, that sort of a thing. So again, that's a great partner to have because, if you do partner with someone like that, they have a skill set that you don't necessarily have, that just makes a good partner. And then he was also looking at it and he basically was an inspector. Like between him and the realtor, they could go around, they could see what the bones was. Is this something that they could easily fix? They could sort of figure out the cost because we've done this before. And, it started to get a little bit more appealing. It still piqued my interest. So eventually we did go inside. We were allowed to go inside. And, basically on that day, we decided, even though I just met this family, we decided between all of us, we were going to actually make an offer on this place. So ultimately it became the family, the realtor got involved too as an owner, and then myself. Now we put an offer, we put some clauses in there. Like again, we hadn't really done a lot of due diligence, not only on the property, but as well as ourselves and what our needs are and things like that. So we did put a whole bunch of subjects in there, knowing that we could possibly need to back out for whatever reason. And basically we took some time to really get to know each other and to really know the property. So for one, we all wanted the property. We thought it was a phenomenal deal, good investment for both sides. This really ticked off a lot of the stuff that this family needed. It was literally half an hour from everything. So like half an hour to Richmond, half an hour to the port, half an hour to Surrey. That saved them a tremendous amount of time. From my perspective, price point, really liked this family. Really liked who would be living right next door to the unit that I would have. And I was thinking of it as an investment. It is an investment for me. I don't live there, but they would be living there. So if there were issues and we had a good relationship, a good rapport, then I could call on him to, help me out on my side. So again, we're going to be helping each other out quite a bit on many steps. So during that time when we were doing our due diligence, I put my financial planner hat on, my planning hat on. I said, ask all the regular questions. What if we hate each other? What if one of us dies? Is there insurance on this? How do we protect ourselves? What if someone splits up? I basically was very much a devil's advocate and went through all these different scenarios of the what ifs, all negative. Because essentially what you want to do is, while everybody's on the same page, while everyone's happy with each other, that's when you want to write the rule book. The last thing you want to do is, if something goes wrong, then you sort of have to figure out who's responsible for what. and who pays for what, how do we make valuations, all those sorts of things. So we took about a good 2 months where we had to really put our thinking caps on and decide of all these various scenarios. And we also said, okay, this is what's going to happen. For example, if someone wants to leave within the first 5 years, there'll be a penalty for that. They will, how will we put a value on the property? Who has the right to take over that percentage, if there's a right at all? All these sorts of things we had to sort out. Basically we ended up with a handbook. And I just did it myself. Like between all three of us, we sat down, we did it ourselves. I would say it's about a good 7-8 pages talking about everything from mortgages to who does landscaping, to small repairs, to big repairs. How do we finance it? Again, I think I mentioned life insurance. What if people get divorced? All those sorts of things. And that is our guidebook, and it's something that we use. I don't think we've ever had to use it because we've become good friends throughout this time, and we just sort of do what we always do. But there's pitfalls to it, to the co-ownership side as well, because one of the things that I'm thinking about is, well, one of the things we made clear is because it's an investment on my side and because it's their home, we do treat it differently. So I basically told that family, under no circumstances will me and my realtor friend force you out. This is your home. So when it comes to a sale, we said up front that yes, they would be driving the boat in terms of when a sale would happen. Now, the problem from an investor's perspective is, well, they could live there for literally decades, and I might need a liquidity event, or I might need to borrow against it, all these different things. So I had to think about that. So part of it, sorry, my dogs are playing in the background, but part of it is, just hold on a second. I go, take the dogs. Sorry about that. So part of it was we had to figure out, before going in, I had to have an exit plan. And I think everybody has to have an exit plan going in, because in relationships, they do go sour, investments do go sour. So you need some way, some mechanism that partners can actually exit from these projects. So we had to write that down. Now, one of the main reasons I really like this place, beside it being a fourplex, being flexible, is actually its location. So its location is in an area that's already zoned commercial. It's surrounded by a whole bunch of towers. It's beside just 3 or 4 other homes. These were built as family homes. So in my mind, it's just a matter of time before these neighbors get together and it'll be sold to a development. Someone will build a tower and we're going to be out of there. So I knew that going in is one of the factors that made me decide to buy it, as well as my neighbors. And then it would be a win-win, because without this family, I wouldn't have bought this place. And without the family wouldn't be able to buy this place without us. It was definitely like a symbiotic relationship. We needed each other, but we all decided, okay, well, our number one plan would be a liquidity event, sell to a developer at some point so that we can all sort of go our separate ways eventually. Because I don't want to be partners with them forever. I'm happy to do it for a good number of years. But ultimately, I'm thinking long-term again as a planner, and I can't remember who it was. Maybe David was saying that people have to be very creative and think outside the box about, buying real estate. And I'm thinking about intergenerational. So my thought process when I bought this place was this would not be really for me, but it would be somewhat that my kids would probably use as a tool, either through a liquidity event where it gets sold and they can use that as a down payment, because I don't think they're going to be able to make several $100,000 a year that it takes nowadays. I just, as much as I wish that on them, I just don't think it's going to happen. So I do think for them to buy real estate, which I do want them to buy, I think they're going to need a little bit of a help. And in my mind, this was the project that I thought would suit them. And I thought the timing might be right. Now, I could be completely wrong, and the family could have to live there for many years. And maybe it doesn't get sold to a developer. I don't know. But if that's the case, I still have access to a 3-bedroom townhouse upstairs and a 2-bedroom townhouse downstairs, apartment downstairs. So I figured, from a risk reward perspective, it's something that it's an asset that I wanted to have, a card in my back pocket that probably will go on to the next generation.
Fantastic. Thank you. So definitely, it's always good to see when when the professionals are doing this. It's a nice sign of confidence for the rest of us. What's actually interesting that I've learned in this work is that professionals do co-ownership much more than the lay person. I think they really get the advantages and the opportunities that come with it, and can do it with some confidence because they know the processes. You knew to ask those questions and to put together that whole legal agreement. So talk for a minute, take off your personal experience hat and talk as a financial planner. If somebody comes into you and says, I'm looking to co-invest with a friend in this property, or I want to put my money into my children or whoever it might be, into their housing situation, what considerations would you ask them to explore? What are the thoughts around issues of liquidity, risk reward, relationship that you think are key as a financial planner?
Yeah, you got to think of it all. I mean, dual co-ownership is basically just as serious as being married. Like, you have to pick your partners well, I guess, is the number one. And you also have to have the same type of goals, I guess. So like if I'm a young family versus someone who's much older, we might have different goals. Or if I'm an early 20-year-old, from 20 to 30 years old, their life could change dramatically. They might, get in relationships or, have children, and how does that affect things? So all these are considerations that you have to do. Now, like financial planning perspective, there's also the estate side as well. Like there's taxations, there's different rules around that, principal residences, all these new taxes that we're talking about, what kind of usage, like, someone might want to Airbnb, someone might want to sublet at some point, all these sorts of things I figured out beforehand. And again, I didn't consult a professional. It's just something that we sort of came up with. And I wouldn't consider myself a professional in co-ownership. It's more of I'm a participant. But I think there's a lot more resources out there now. And I would encourage people to look at those definitely before they go into it. At the beginning, it's all almost romanticized. Like, oh, kumbaya, we're all going to get together. Everything's going to be great. But as a financial planner, I'm always thinking the opposite side. I'm thinking, what happens when things go wrong? And almost I would say every piece of real estate I've owned, and I've owned several properties, and I continue to own several properties, I've done them always with partners. I just like the partner type of style. And I do pick people that I trust completely. Like sometimes it's family. I own a place in Whistler with my brother. I've owned in the past a couple properties with that real estate friend. I owned this house with my wife. So I kind of like spreading the risk, and I kind of like spreading the benefits as well. And I think it's really helpful actually having a partner where you can talk through issues with and problems, because there's bound to be problems and issues. Like every property we've had some issues. It's never gone completely smoothly. And even right now with this co-ownership building that I'm talking about, we're running into some issues now. One of the partners is having some marital issues and might break up, and we have to figure out how all that lands. And I'm very thankful we have the guidebook that it's all written out beforehand, so there's no real dispute between one partner and another partner and that partner's spouse. So yeah, so my tips, I guess, if you're considering this, is really know a lot about your partners and what their goals are with the property. Make sure they're aligned, and then seek guidance. If there are professionals out there who do this, learn from them. It's really quite hard, I imagine, for someone to navigate if they're completely green to it, and luckily there are resources out there.
Fantastic. Well, Mark will be sticking with us for a while, and he'll be available to take questions after we hear from our other two speakers. So please throw your questions in the chat if you have them for Mark, or make a note of it, and there'll be a chance to offer them verbally later. And Mark, will also be interested to hear your take on our next speaker's approach when we come back around later, because our next speaker is Stephen Jagger of Addy Invest. Stephen is a co-founder of Addy Invest, which is a real estate crowdfunding and co-investment platform. My words, I'm sure he'll better define it himself in a moment. Allowing investors to co-buy real estate at much lower levels, starting as little as $1. So while much of the stuff that we're doing here at Coho and that Mark is talking about is 2 or 3 or 5 or 6 people coming together to buy real estate, that still creates a huge barrier to entry, financial and also from a liability perspective. And so Stephen is part of a movement looking at how to spread that out, and allow people to get it at lower prices, diversify their portfolios, etc. So I'll let him introduce himself and tell us his story and how he sees co-investment as a pathway, a viable pathway going forward as an investment tool, and similarly some of the considerations that people need to look at before jumping in to these crowdsourcing platforms, which are starting to get more and more common. So thank you, Stephen, for being here.
No problem. Thank you for having me. Do you mind if I can share my screen?
Yes,
all right?
Please do.
So I don't have a deck, but I'll just share the website because I can talk through what we do using that. Hopefully you guys can see it. Okay, so Addy, we are Canada's largest real estate crowdfunding platform now. Big picture, what we do is we enable retail investors to be able to invest in institutional commercial grade real estate for as little as $1. And how this started was this single family house on Trout Lake back in 2018. Myself and my business partner wanted to figure out if we could create a technology platform that enabled people to invest very small dollars into a specific address or a specific property. And we thought we could figure out the tech, but what we didn't know necessarily was, do regular Canadians want to do this? Was there an appetite to invest small dollars into specific properties? And so we put this single family house on the first version of the platform. And it's right here on Trout Lake. It backs right onto the park. It's kind of a great location. And we bought this property for whatever it was, $1.6 million approximately. And we put it on the sort of the rudimentary first version of our software, and we put it out to the world, or we put it out to Canadians, I guess, through the internet, through Facebook ads, Google ads, basically trying to figure out, do people want to do this? We're trying to validate the idea of the business, essentially, because when you're starting a startup, I don't know if anybody started a tech company, it's pretty common to have friends and family say, yeah, great idea, like you should go do that. And then you try and sell them that exact service that you're talking about, and they're like, oh, no, I wouldn't pay for that. So what we wanted to do is validate that we were getting real people that didn't know us, weren't related to us, choosing to do this. And we proved that it worked. We have 300-ish, I think it's 303 investors in this first property. And it very much validated for us. Some of them are for sure my friends and family, but 200-ish of them, I have no idea who they are. They found us through the internet and they chose to invest in this single family house. This one is a development. It's actually almost done. It's been ripped down. A duplex is being built. It'll be sold off and everybody will be exited out. But that's kind of where we started. So it's back in 2018. We kind of fast forward to today. You can look on the website at any time and see all of the past properties. They're all institutional commercial grade real estate. You can see this was a church in Oliver that's being converted to rental housing, 660 people invested. This is development in Ontario, 1,180 people. These are those Calgary conversions. I don't know if anybody's heard about those in Calgary. They're converting downtown Calgary towers to residential. And we were part of 2 of them. The Cornerstone here, 800 so Canadians. Another one was the Petrofina, 770 Canadians. And so basically what happens is people have the ability to go on the platform, review the details of a property, and then make an investment decision. So right now there's 4 properties on the system. This is an example of one of them. This is the 20 townhouse complex in Calgary, Alberta, in Altadore. People can invest literally as little as $1 up to $10,000 per property, or you can go above the amount of $10,000 if you're accredited. But you can see we have 892 investors have invested an average of $574.50 into this property. There is about $90,000 left of the equity slice that was available. But you can see all of the details are broken down. There's videos that are made that explain the opportunity. And people can make an investment decision by not only creating an account in the platform and seeing all this stuff, but you can see all the due diligence. So you can see the property condition reports, appraisal reports, building condition, whatever documents the general partner has, they share all that information so people can make a decision to invest in the property or not. The properties all range, to give you an idea. They are, like I said, all institutional commercial grade real estate with the exception of our first property, which was that Trout Lake House. Everything else fits into the category of institutional commercial grade real estate. So multifamily buildings. We've got 3 hotels in Quebec. We've got an industrial park a couple hours outside Toronto. We've got an RV resort a couple hours outside Toronto. We've got 10 developments on the system from Vancouver to Victoria to Toronto to St. Catharines, Hamilton. So we're kind of all over the place. And the idea is to enable people, just like you guys were talking about at the beginning, is your average Canadian is now essentially locked out of the market. And what we wanted to do was figure out, could we build a platform that enabled the community to be able to participate in the ownership? And so what I mean by participating in the ownership is everybody's participating in, if there's passive income to come, you are paid out like an accredited investor. If there is capital appreciation of the property, you participate in that. The mortgage pay down, with basically the renters paying the rent, there's mortgage pay down. The investors all participate in these benefits of real estate ownership. And so it is a very unique way to take part in institutional commercial grade real estate, because the vast majority of these opportunities are essentially hidden away from the general public, either because you don't have enough money to participate, and even if you do have enough money to participate, you usually don't even know that the deal's there, that it's available. They usually happen quietly. A lot of these buildings trade off market. As an example, I'm in the Addy office here in Kitsilano in Vancouver on 4th. Our building was just sold. Chip Wilson bought it 6 months ago. We didn't even know it was for sale. It was a quiet deal done between the current owner of the building, sold it to Chip's company. The whole transaction happened, and we just got a note saying, by the way, there's a new landlord, it's Low Tide Properties. We're like, okay, cool. And that's how most of these transactions happen. They're just quietly done off market, and the general public doesn't even know, let alone have the opportunity to participate in it. And so all we're trying to do is make that investment opportunity available to Canadians across the country. And now we're 36 properties in, and the most recent addition to our world is America. So we've launched the first American property on the platform. So this is for Canadian investors investing in US dollars in an American property. So this is a student housing complex in Stillwater, Oklahoma. It's right by Oklahoma State University. But it's another version of diversification for our community, where they can now invest in a different currency in USD, and they can invest in a different country's real estate assets, in this case, student housing in America. So that's kind of where we are at today. 36 properties in. You can all create an account if you want to participate. There's thousands and thousands of Canadians on the platform. To give you an idea of where we're going, thus far, all of the properties have always been equity. We're in the process of about to start bringing on debt. So people will be able to invest in the mortgage, like into first and second mortgages through the platform, and participate in the debt side of real estate investing. So the debt side is coming very, very soon to the platform. So we'll have more opportunities for people to invest that are looking to generate, monthly cash flow out of a mortgage payment coming back to them. To kind of give you a big picture and how we did all of this is, we are a tech company. We've basically built a very complex software platform that makes it look very easy to the retail user, but underneath we're deep in securities regulation, we're deep in sort of the legal regulation, and we're deep in finance. Our software is moving, thousands and thousands of transactions, small dollar transactions every single day come in and out of our system. And now we're doing it in both currencies, and enabling people to sign subscription agreements and make investments and get dividends back. And just all of it is all done through the platform. And we are at the point now where we're licensing the software to people that want to use the platform to manage an investment. So if you do have an investment or considering an investment, you're going to have maybe not 1,000 investors, but maybe you're going to have 4 or 8 or 6 or whatever investors in your property. You can use what we call the Addy business platform And it basically enables you to keep track of the due diligence documents for the property, do investor updates to your handful of investors. If there is going to be a dividend pushed out every month or every quarter, every year, once in a while, you can use our software to run the dividends. The software spits out all the T5 slips for the investors, or T5013s, depending on your legal structure. Like, the whole thing has been made very, very simple so that small groups can use the platform to run a handful of investors, all the way up to big groups running 3, 4, 5, 10,000 investors in a property. So it is quite different for what's out there. Like I said, we are Canada's largest real estate crowdfunding platform now, and there is lots to come. I'll stick the link in the chat. I made a little promo code if you guys want to play with it, sign up. It's free to sign up, but there's also a $50 a year paid membership that gives you some benefits of the software, but that promo code will waive that fee. But I don't know. I hope I'm on schedule here, on time. 10 minutes.
Yes.
10 minutes.
So thank you very much for that presentation. Talk a little bit about what we see as the advantages and also the challenges of the crowdfunding model and your technology versus a direct small scale co-investment, or versus buying a condo on your own, or some of the more traditional REITs. What are the advantages, and what are some of the challenges that considerations people should think about in advance when they choose their model?
Yeah, it's a big question, but I'll do it quickly. The difference between us and a REIT, you're basically buying a basket of properties. So the benefits are it's public, you can trade and sell your shares whenever you want. The downside is you don't get to pick and choose your properties. So you're investing in like Canadian shopping malls, REIT or whatever. You're getting shopping malls in Vancouver and Toronto, but you're also getting Winnipeg and Edmonton and Calgary and wherever else. And so you maybe like some of those places and don't like others, but you don't get to choose. It's either get in the basket of all of it or you're not. With Addy, you're picking and choosing your properties. No different than we all know we should be buying the S&P, Vanguard, whatever ETF for the stock market. Warren Buffett tells all of us to do that, to not pick stocks, but still humans just pick stocks because we all think we're smarter than the market. It's the same way for us. Is if you like a multifamily building in Edmonton, you can invest in that specific building. You're not getting anything else that you don't necessarily want. As far as benefits of buying a condo, if you want to buy a condo, you should go ahead and do your thing and buy it. But the lots of the community that are on our platform don't have the ability. Your average condo in Vancouver is 8, 9, whatever it is. You guys would know, $800,000 or $900,000. Like, they're just beasts now as far as pricing. So we've got lots and lots of people on our platform that are just choosing to deploy capital. They want to be in the real estate market, but they don't want to be 100% into one property. They would rather be spreading that investment across not only different asset types, but different cities. Like, we've got an apartment complex in Kimberley, BC. It's a town of 7,500 people. Our apartment building is the largest building in Kimberley. So you can go from a small little town like Kimberley all the way to like Cliffside development in Toronto. It's a $130 million development that came out of the platform. So it gives people the flexibility to be involved in all aspects of the asset class in a way that is prudent for them, depending if you want to put $5 in or $5,000. It's up to you.
All right, thank you.
Did I get most of your questions?
Yeah, absolutely. So we'll come back with questions for Stephen. We had a hand up there for a moment and they put it down, but there'll be time to ask Stephen questions about his style of investment and his platform in particular. But right now, I will put this back on and thank Stephen and invite Richard Bell of Bell Alliance to share his story. Richard is a local lawyer specializing in real estate and estate planning and family considerations, and really one of the pioneers of co-ownership in BC. He's also a co-owner himself, living in a family compound and co-owned with his children. So Richard, you'll tell us your story, excuse me, and a little bit about what considerations as a lawyer you feel like people need to think about when investing with strangers, but also when investing with friends and family, and how those might change the equation, if you would. So thank you, Richard, for being here, and we're looking forward to hearing what you have to tell us.
My pleasure. Stephen, you guys have come a long ways. Well done. Well done.
Well, thank you.
Stephen and I know each other from many years ago, and it's really progressed, Stephen. So I built what I call the Bell family compound. And if you want to meet the Bell family, just plug it into the internet for Bell family compound, and you'll see us there. So I have two daughters, and my wife and I were looking at how do we create the opportunity for us to visit our kids by just going to another unit on our piece of property. We were very fortunate. We owned a property in Vancouver, as opposed to driving further out of the city every time we wanted to see them. So what we did is we actually gifted a portion of the dirt, which is really, as we know, where the value is in most real estate, to our kids. So they became part owners of the property. But and Warren Buffett's mentioned, his name has been mentioned already, but Warren Buffett's advice always to everyone is help your kids, but don't help them too much. So what we did is we had our contractor calculate the cost of construction of each unit. And then I put a mortgage on the property. And what each child does is they pay for the cost of their unit. What it does, though, it does point out one of the challenges of co-ownership. There's one property, there's one mortgage. Whoever is on title to that property is 100% responsible for that mortgage, even though the lender may be just debiting each owner's bank account for their pro rata share. And I will do a call out to Van City because they're one of the lenders that really have been so very, very supportive of the co-ownership model. A number of the brokers like Mark deal with others, but they were the ones that were probably leaders at the beginning of this whole co-ownership structure. But here's the challenge is one daughter decides she needs to have a new car. So dad gets the phone call, which basically says, Dad, I don't qualify for a car loan because she is responsible for 100% of that one mortgage. So dad now has another debt because he had to become a co-owner of a brand new, beautiful Kia EV. Great car, but dad wasn't expecting to be buying a new car. So that's, and again, and Noam talks about and also Mark talked about, the importance of an understanding as you come together. So I always refer to sort of an intentional document, whether you're coming together with family or friends, to really sort of document something that says, this is going to be a different living arrangement. Everyone will contribute differently. And we have to recognize that sometimes you may be feeling that someone's not contributing as much as they should. And my comment usually, just get over it. They are who they are. So we see a lot of co-ownership coming across our desk. We do a lot of these agreements. And one of the key things really when you're looking at this is what I refer to as the what ifs. What if there's a divorce? What if there's a transfer? The fact that there is one mortgage, and when people come together, it's a little different for family, but when friends come together, someone may be coming into that purchase arrangement with more capital than someone else. And so, but yet that person with more capital becomes responsible for the portion of the mortgage that the person with less capital has had to access to be able to pay for their share. So again, lots of issues to be discussed. Similarly, I've had clients who, aging parents who think, well, Richard's done this, it's a great idea. But for some people, the majority of their equity is tied up in the real estate. So if mom and dad have to go into care, they may have to have a discussion with their kids that we need to sell the property because most of our equity as aging parents could be in that property, and private care in a facility is very, very expensive. So it's just sort of a discussion around all those issues that can come up with this structure. Now we see different scenarios. We see the sort of scenario that Stephen's doing, which is really a nice, clean investment strategy. You'll see investors coming together where they're going to buy a property, they're going to rent out the units. You're going to see scenarios where an investor comes together with someone else who's going to be living in it. And again, a different discussion there. You know, is there a timeline where everyone says, no, nobody's going to be able to sell this for a certain period of time, except, or if it has to be done, then there's perhaps a discount off of fair market value. You see friends coming together to be able to buy properties, and you see families coming together. When you have families coming together, you also have to have an estate planning discussion, because you may be creating an opportunity for a child that lives and works in Vancouver or the community that this is being done in, but you may have another child in Toronto and New York or any place in the world. And so the child here may have that great opportunity of increasing value because they've had their parents help leverage the acquisition of real estate. So it truly comes down to every scenario is slightly different. Probably in our firm, we probably have, you know, at least a dozen different formats of co-ownership agreements. The other thing that's happening, and Noam's well aware, and I think most professionals are aware around this discussion around densification of single family lots. So I chair an organization called Small Housing BC, and this will create new opportunities where properties can be stratified. There will be additional costs associated with that. So some people will continue to look to the co-ownership model. But within the next few weeks, we'll see the provincial government introduce new legislation around single family lots being able to be densified with stratification. And so that addresses one of the issues that I talked about earlier, where everyone's responsible for 100% of the mortgage. We will see scenarios where friends come together and families come together to be able to buy a piece of property. So they will buy it in a certain co-ownership structure initially, with everyone entering into agreements as to how they move forward if they do decide to stratify the property. So, you know, the what ifs, it's all about the what ifs, and every scenario is slightly different. But this is one of the big ways in which people can get into the real estate market. And what's interesting for me to watch everybody who's presented so far tonight, there's a whole bunch of different opportunities for people to participate in the real estate market. Ownership is tough. I'm not sure affordable is the word anymore. We're now talking about attainable. What enables someone to attain ownership where they're occupying, or in fact an investment opportunity. So those are sort of my comments. It's a big change, it's a game changer. This has happened globally. You know, you've got Ontario with new legislation, California, Minnesota, parts of Europe, Australia. Everyone has, you know, the basic problem is wherever you would like to live is really expensive. So what can governments do to try and offset the negative impact? Because we are facing a world where the spread between the haves and have-nots has been dramatically increased because of real estate being such an investable asset. So those are my few comments. Happy as we go through this to answer any questions.
Fantastic, thank you. And I'll just, I mean, you did sort of answer this question already, but I'll ask specifically, are there any particular things in addition to estate planning, let's want to get more into that like differentiate as a lawyer what you should think about if you're doing this with family versus with friends versus with strangers, and how you might think about it differently if you're going in a purely investment perspective, or if you're going in as end users looking to occupy this as a home? Are there any particular things that we should be thinking about in these categories?
Yeah, I think when you're talking about family, where you get children having different opportunities because they, you know, that example I give you, where you've got a child who's living in Toronto and course, Toronto isn't affordable either. Someone's living here and that child gets the benefit of being an owner of the property, perhaps. So how do you equalize that? And that's the discussion we have where, you know, some parents have enough capital to be able to equalize right at the beginning where they can say, okay, for my child in Toronto, I'm going to give them a couple $100,000. What's couple $100,000 in today's world? It's tough for most people to come up with that cash. So I think that's really, it just is part of the discussion when not everyone's participating in the opportunity. When it's a straight investment, it's pretty simple. This is just buying stock, buying real estate. I think that the big advantage of real estate is the ability to leverage more. That's, I think, not a lot of issues around estate planning when it comes to the real estate, when it comes to an investment strategy. Lots of issues around just normal estate planning issue and assets, and how do you avoid the dreaded probate fees and the complications of years of wrapping up an estate, but that's a topic for another night.
Thank you. Yeah, I think it raises, you do raise an important point that sometimes when in co-investment, you have to remember that your partners are not always at the table with you. In that, right, when it comes to family, you have other siblings who have an economic stake, could be more an emotional stake in mom and dad's assets. When it comes to friends and strangers, you may have future life partners or estates down the road if properties get inherited that you need to plan for. So you're planning for the folks that are at the table and the folks who are maybe not at the table but who have an interest in what you're doing.
Yeah, and I think, Noam, you probably have people on here who are thinking about family compound as well as the other areas. And I got to tell you, I've got everything from a 3-year-old grandchild to a 95-year-old mother. And I always say 90% of the time it was a really good idea to build a family compound. There's the 10% where you go, oh, this is, but you know, when a crisis happens, my 95-year-old mother, she has her, what I call every 18 months, the visit to the emergency department. And to be able to have that family come together saying, okay, I'm in the ambulance, I'm at work, but I can come to the hospital for 3 o'clock, and that support, or where all of a sudden, you know, one of the grandkids has a challenge and, you know, can someone take care of the other grandchild? Or my 70-pound dog needs someone to take him for a walk. So it's really, I'm pretty passionate about the opportunity for families to create what in North America is a kind of a unique living arrangement. Not perfect, but it's a lot better, particularly for, you know, creating opportunities for the multi-generational living.
Fantastic. Well, thank you, Richard. So now we'd like to open the floor. It looks like the chat wasn't open earlier. I apologize. There was a problem with that. But I have now changed the security settings to allow folks to chat and to share, turn on their video and unmute themselves to ask their questions. So I did see one hand up earlier, but please, folks, feel free to chime in. While folks are forming their questions, I'll open the floor to our panelists if they have any questions for each other as well, or to Brian and David if you wanted to ask anything of our panelists.
Yeah, I got a question for Stephen. Stephen, love the platform. It's really great. You know, there's a lot of people right now who are looking to, you know, take their cash out of the bank and invest in real estate, who necessarily aren't looking for a place to live. But my question is, does the company buy these properties first and then find the investors? That's my first question. My next question is, who lives in these units? And if it's like a single family detached house like the one in near Trout Lake, how is that managed? You know, when you've got all these owners owning a property. So it's a bit of a 3-part question.
Yeah. Okay. So the first part of it is who's buying the property. So we are not. The Trout Lake property was that first proof of concept property that, yes, myself and my business partner, we bought it. And the only reason we did it was because it was in theory, small enough that we could take it down. And if this turned out to be a really stupid idea, we could still close and get a mortgage and move forward, versus trying to buy a 3 million or 5 million or whatever apartment building, find out that investors don't want to invest this way, and then we renege on a contract that we'd signed. So that's why it was single family. But that's the only one we've done. The other 35 properties on the platform, there's always a general partner that is doing it. We are just the technology. We're the tech company in the middle of it all. So the general partner or the real estate developer is the one buying the property and then choosing to make their investment available to the Addy community.
Okay. Gotcha. So
yeah.
there's a management company. So then the investment's being managed professionally by a management company.
Yes.
Gotcha.
Yes. And some of them are developments where they're building the building. Other times it is a building that exists and they are managing the renters. Or like we have a Starbucks in Chilliwack. It's just Starbucks plays their triple net lease and everybody gets a quarterly dividend out of it. So they all kind of depend. But yeah, we are not running any of them with the exception of Trout Lake. And we're not even running Trout Lake. We have a developer building the duplex for us and managing it for us.
Okay.
And
I'm
there's
just also I'm also curious to know how it even works, like names on title and that form of ownership, what it looks like. How do you guarantee your investment? Like, what does the investor receive back showing that they that it's bona fide?
Yeah, so there's no guarantees on the investment. Definitely not allowed to. We're not allowed to promise anything.
Sure.
The way the legal structure works would depend on the property and how it's being, purchased. Sometimes the property lives in a bare trust. Generally, with our community, they're buying or subscribing to limited partnership units, or they're buying shares of a company, and the company owns the piece of the property. But that's what they're essentially getting, is shares of a company or limited partnership units, and those have certain ownership rights over the property itself, and that's how they're participating in any capital gains upside, any dividends out of it. But their names are not on title. Many times the developer's name is not on title either.
Yeah. Okay. So then in the software that the services you provide, it breaks down people's portions of investment and shows them what their returns are and how to get out if need be, how to sell. Is that how it works?
Yeah, we break down all the pieces of the deal. They can't at this moment. There's no real easy way to get out. Just in that, when you make an investment into like a multifamily apartment building, it's not like there's money sitting there. You kind of own your share of the wall or the doors, or you know what I mean? Like the money is in the building. And the only way, or the best way to get out, is usually they'll refinance it with a new mortgage, and buy out their investors, or they'll sell the whole building and cash everybody out. But a single investor trying to get their $600 out it's an illiquid investment.
Okay, and one last question. These questions are just coming to me in real time. Is there a length of time on the investment? So you invest in, and is there an expected end point when you're expected to get your return?
Yeah, each one has a projected timeline. So there's a deal might be projected for 2 years and a projected return of X, and you make the decision to invest in that. But of course, these are projections. We've only had one exit so far, was the Lex downtown Vancouver on Granville Street. That was a projected 5-year hold and a projected 5% IRR. And we were out of that in 11 months and a 22% IRR, only because the developer or the group that bought the building, it was already a stratified apartment building essentially, and they sold off all of the units and sort of nailed the top of the market and cashed everybody out pretty quickly. So while that was great and faster and better than everybody expected, the reverse is also true. You could be in a 5-year projected hold and it turns into 7 or 9 or whatever.
Okay, thanks a lot.
All right, so
Thank
Stephen,
you.
there's a couple more questions for you on the chat, and then I'll get on to some of the ones for other people and the people who have their hands up. So just quickly, what from the chat here, what does Addy do to ensure people don't get scammed? I mean, what's your due diligence process? Is all info verified? How is it done? And I'll just bring up the other one at the same time. How does Addy help people to buy homes? I mean, I don't think you do specifically. You help people invest in real estate. Is there any distinct benefit to providing more accessible properties? I don't know if I fully understand that question. And also, what's the average ROI? We just talked about that a little bit.
There's a lot. So the first one you said was, how do we vet deals? Big picture, we look at it in two ways. First, we vet the general partner or the issuer, whoever's kind of running the property or buying the property. We vet them first. So we try and we go through a whole bunch of document requests to make sure that they haven't been bankrupt. We dig into their reputation. What do their past investors have to say? If they're building a building, do they know how to build buildings? Have they built buildings like that before? All those types of things. But at the end of the day, we're trying to just understand what are their core values, and are their core values aligned with our core values? Because in real estate, as you probably all know, things go wrong. Something always goes wrong at some point. And we just want to make sure that the person in charge isn't going to step on the investor's neck to save themselves, that they're going to make decisions in tough times that are not like better for them, but worse for their investor. We just want to make sure that we are aligned in how they think about managing a difficult situation. And then if we're happy with all of that, then we vet the deal itself. So we'll underwrite the real estate. We've got a real estate team that digs through all the documents. We'll usually send somebody to the site. We pull title, and then before all the money moves and the investment actually happens, we pull title again. And then every year after the investment's done, our software pulls title. We keep pulling title to make sure nothing's changed that we don't know about or shouldn't be on the title. And at the end of the day, something could go wrong. We look at it that we are a platform, but I do know we have brand risk. If something goes sideways, people will blame Addy. So we are very cautious about what goes on. Most things don't come onto the platform, either because the timing's not right for them, the amount they want is too big, we don't like the group, or whatever. But there's lots of reasons why things don't come on. But yes, we do vet the deals, but everybody should vet them themselves and make their own investment decision. We can't give anybody investment advice. What was your next question? How do we provide homes? We don't really provide homes. There's a potential for us to do so in the pre-sale world, where we can enable the Addy community like we do to invest in a development before the development is built. And we do think that there's a way where the Addy community might end up buying one of the condos when the building is done and using a lot of their upside that they've gained to help them with their down payment, because there's a lot of fat in these deals that a lot of people make money on that are not the end user that's buying the end condo. They're paying full retail market rate, but there was money for the marketing company. There was money for the lawyers. There was money for the investors to make all this money along as the development becomes de-risked. But we do think there will be a way, and there might be someone buying one of the Trout Lake units. There might be one of our existing initial investors in that property that ends up buying one of the duplexes, which I think would be very cool. I don't remember what your other question was.
All right, that'd be good. That's good for now.
Okay.
So a little change of pace here. I have a question from Eileen. If I am a first-time home buyer and buying with a co-owner who is not, am I still able to access those government perks on being a first-time buyer? And I'm going to ask Mark if you're feeling confident enough to answer this question, and Richard, you might have something to weigh in as well. Sorry.
Yeah,
I
I'd probably say
understand it.
this-
Oh, it's like, I understand the answer is some yes and some no. So Mark, go ahead.
So this is just off the top of my head. From what I understand, if there's one person who's done a principal residence and one person who hasn't, like a spouse, then I think one person is allowed to do their allotment. But I would definitely defer to a lawyer in this situation. So I'm going to throw it right back to Richard.
Yeah, so no, they base it on what's the total price of the property.
But it depends on the particular program we're talking about, right? So for example, the ability to withdraw your money from your
RSP.
RSP
Yeah.
is allowed even if you're co-owning. You might not
That's right.
get the property transfer tax break, and I don't know about all the other new federal and projects. So it's really it depends on the initiative you're looking at.
Yeah, and it depends on new construction with 750,000. So there's a number of different programs, but if you're thinking about property transfer tax and being a first-time buyer, it's based on the purchase price. And I guess if you were buying in SPUSM, you might actually qualify as for the property transfer tax exemption, because the threshold is under 575,000, I think. But yeah, RSP you can access. You're buying something that's a brand new construction. Again, that's a 750,000 threshold.
Okay. Thank you. We have a question here from Kat. Any recommendations for lawyers to help draft agreements? I mean, clearly we have Richard and his team at Bell Alliance, and we do also have other lawyers that we work with around the province that some are on our website and some we can connect you to. So yeah, connect with Richard, and Ryan is his colleague who does much of the work there. And if they're too busy because they're doing a ton of other deals at the moment, feel free to reach out to us for other recommendations. There are more in the chat here, but David has had his hand up for a while. David, would you like to
Sure.
chime in?
Yeah, I've got a question for Stephen and one for Richard. Stephen, you talked about participating in the debt side and being able to get monthly payments back. So is that you're investing in mortgages? Is that what you're talking about?
Yeah, investing in the mortgage itself, like providing the mortgage, providing the debt on the real estate.
So is that done through the Addy platform?
It will be, yes. Yeah, so people will
Not
be
yet.
able to. Not yet. We haven't launched it yet. It's coming soon. We've got
Okay.
lots of people on the platform that like monthly or quarterly distributions, like the cash flow, and
Yeah.
investing in a mortgage is a good way to do that because it happens monthly. And our software is good at dealing with thousands and thousands of transactions and splitting the money accordingly automatically.
Okay.
So debt's kind of the next piece.
What timeline?
We're like actively on it. We hope to launch the first one before the end of the year, the first debt offering.
Okay, a few months. Yeah,
Yep.
so essentially, it sounds to me like just kind of quickly looking, and I'll do some more research later on your website, but so if a person invests and it's like you say, a 3 or 5 year term, it could likely basically payout's going to come if that building is refinanced or sold, correct? So it could be, like you say, double the amount of time. That's if it's a 3 year term, it could easily become a 6 year term, or a 5 year term become a 7 year term.
Potentially, depends on what the building is, what the operator, like the general partner, the issuer is doing. Like imagine we all invested in a strip mall that was full of mom and pop restaurants, and the plan was to exit in 2020. We all invested in 2015, and it was going to be a 5 year hold, and 2020 comes around, and that was the plan to sell the thing. But COVID happened, and all of your tenants are closed. It's probably not the best time to sell. And so if the owner could hold on with no income coming in, you'd probably want to. Some people are obviously forced to sell, and it's not the best time to sell. But those like reasons like that is why things can be delayed. Investing in developments are constantly delayed. Like we've got a handful of developments that are just delayed because the supply chain's all messed up, or the cost of lumber, cement is different, or whatever it is, and so they're waiting for city hall to get their act together and approve things.
Okay, so basically the exit strategy is disclosed with each investment.
Yes, there's an offering document attached to each one. If it's a crowdfunding offering, there's the crowdfunding document. If it's an offering memorandum, there's the OM that's there. It basically breaks down the risks and opportunity of the deal.
Okay, awesome, thank you. Richard, I understand that you're part of this diversification or stratification that the government's coming out with. I haven't heard of that yet. It sounds exciting. That's BC legislation, correct?
Yeah, so what you've had a number of municipalities that have already amended their bylaws because they knew that this provincial legislation was going to come down. So Victoria was sort of a leader, but they made it so restrictive they virtually had no applications. They've just redone the bylaw, and since doing that, they've had I think 5 or 6 come in immediately.
You're talking about the missing middle initiative
bylaw amendment, but the province is introducing. So Vancouver was about, I guess, almost 4 weeks ago, unanimous decision by council to allow for densification of up to 4 units on a single family lot. But the province will introduce this month, we understand, which will then go through, get passed in November, is when we expect to see the provincial legislation come down.
So you're
I did,
talking about the missing middle initiative in Victoria. Is that what you're talking about?
That's right. Yeah, you can also find a lot of information on Small Housing BC's website. And when you see a
Small Housing
picture of
BC?
a family, it's my
Yeah.
family sitting in on the front porch. So you'll
Okay.
So Richard, you were just talking about the legislation coming. So we have a question from Donna here, basically, is how will the BC decision work in municipalities that are resistant to change? So do you want to talk a little bit about the politics of this initiative?
Yeah, I always describe it. Our premier has a carrot in one hand and a stick in the other. The carrot seems to be working quite well. We've seen a number of municipalities take a step forward. A number of them approved developments that had been rejected before. So the movement's on, but the province has their naughty list, which they think announced their first 10 municipalities on the naughty list, which included Vancouver, Oak Bay, number of municipalities, West Van, which was always fun to see West Van on the naughty list because they're one of the most reluctant ones to move forward with this. And then they will add another 10 to the list. But the provincial legislation will impose densification on all the municipalities in the province. And they will also introduce some technology to be able to make the whole rezoning process more efficient for municipalities.
All right, fantastic.
I just put a little link in there. I did an interview with Ken Sim a few days after council had put that out for City of Vancouver. So if you're curious later, you guys can see the video of him basically talking about what the plan was, what they were going to do, how it's going to work, what people's concerns of like how is it going to deal with sewage and garbage collection and parking and all the stuff that people are normally concerned about. He kind of talks about all of it. If you're interested, you can see that.
Fantastic.
Yeah, he's probably just quoting my speech at the public hearing, probably.
Richard, while you're on a roll, we've got some more questions for you here, or I mean, anyone can weigh in. So we have a question from Tanis. Is a strata ownership as valuable as a part ownership on a single mortgage? Or, I mean, generally strata ownership properties tend to be more valuable in that their ability to trade independently and to finance independently, which is one of the reasons why people tend to lean towards them. But could you talk a little bit about the differences and the advantages and disadvantages of developing as a strata lot versus a co-ownership of a home?
Yeah, I mean, going strata is going to be more expensive. You know, I don't have a number on that, but you know, one of the key features is each individual, or it doesn't have to be an individual, but you know, think about the family. In my situation, you know, it would be much nicer if my one daughter who wanted to buy the new car owned the strata unit, because she would then, because the amount of her mortgage wouldn't be the equivalent of the one big mortgage on the property, so she could still get her car loan. So, and then if parents have to go into care, for example, they could sell their strata unit, or they could rent it out. I see a whole number of opportunities. We've got, you know, I've got clients that are, you know, they'd love to stay in the community, but most of their wealth is buried into their property, and so they don't have the capital to bring in 24/7 care. So they're forced to sell now so that they could then afford to move into a facility. And I sort of go, wouldn't it be wonderful if they could sell off part of their dirt and get some of their equity out to be able to provide for care in their home, in the community they've spent the 80 years of their life living in. So there is a real advantage to it because you have an ownership of a strata unit, which has a separate mortgage on it, and more flexibility for disposition in the marketplace.
Great. And now, of course, we at Coho are selling shares in co-ownership properties now. So we're trying to create a pathway for someone like that to be able to sell off their floor, but we cannot in any way claim that that product is nearly as liquid and as easy to sell or as easy to sell quickly as it would be if it were stratified, for sure.
Well, no, and sometimes these co-ownerships are in one building, right? And so, you know, stratification of that one building, that old building that's got 4 units in it is, I mean, call it impossible. So,
Yeah, going back and re-stratifying an older building, you usually have to bring it up to full modern code, and it just is, it's cost prohibitive. Mark, we have a question here for you. And this is specifically about your example, but I think we can generalize broadly from it. So, how do you calculate cost shares of maintenance? How much to spend? How do you split those costs, those that live in the house versus those that don't? Um, are you totally a silent investor, or all costs taken on by your partners? Do you still pay a share of the annual maintenance and taxes? Is your share covered, I guess, by your tenants? What do you recommend? And of course, the general statement is every project is unique, which is why you work with the Coho team and professional lawyers and all these folks to develop a plan that works for you. But what's your system, and do you have any general suggestions on how to do it or do it better?
So in my case, I got two sets of tenants. One group that's in the 3-bedroom townhouse, and one family, they're two families, one family who's downstairs. And it's their home. I mean, they've been in there for, we'll say, 5+ years. So they treat it as their home. I go visit it once in a while, but I really don't have to be all that concerned about maintenance. I go in there and their house is cleaner than my house. So they really take good care of it. Now, outdoors and everything, well, I have the family. Now, the family who's there, who's on the other side of the duplex or fourplex, again, they treat it like their house. They do all the landscaping, they do all that sort of thing. Now, if they need equipment, like he'll text me once in a while and say, hey, I could use a new lawnmower, or I can use this type of stuff. Do you mind pitching in? And we always say yes. Sure, pick it up at Costco, buy whatever you want, we'll pay for half. Now, big things, that's where things get a little bit dicey, and that's why we have to have a bit of an understanding. Again, all this was written out in our documents saying who pays what, who's responsible for what. But essentially, it's simple. Like if the roof needed fixing, it was fairly old. We went up there, we patched it a couple times, but eventually, you can only patch it so many times. So we decided to get a full new roof. Now, in that case, the family couldn't afford it at that time, but it needed to be done. So again, we're a team here. They help us out, we help them out. So me and the realtor partner, we paid for the whole roof. We set aside the amount that they could pay. We paid up front, and then they just paid us back in installments, 0% interest, that sort of a thing, until they're done. Sort of at their leisure. They set the time frame. So again, it's a lot of give and take. We really trust these families. Maintenance, anything comes up, we talk to each other. Communication is key, and we just split it that way. There is stuff that is formally down in writing, like what happens, but ultimately, we've never had to rely to that. Generally, just having a conversation is good enough.
All right. Yeah, and so every situation is unique. I mean, from the roof perspective, is one of those good reminders these things happen, and a lot of times we encourage folks to kind of set up a contingency fund. Put some rainy day savings aside if you can. All sorts of models so that it doesn't come down to that. And of course, in your case, you have tenants, so you're bringing in income, so you pay your share of all the costs. Sometimes if you're investing in somebody's home, I'm going to put 20% down of your house just so you help you get in the market. Maybe that person who owns that condo or that house with you, but who occupies the whole space, might choose to take responsibility for all of those ongoing costs. You do see co-ownership models like that, where the investor is a silent investor and is really only there to ride the appreciation wave or whatever it might be, and the occupier will take on all those responsibilities. So it's part of the conversation you have in advance to figure out what's the model that makes sense for each of you. Scott has a question here. Can anyone recommend a mortgage broker proficient in structuring co-ownership financing? And the answer is yes. Reach out to us off after the fact with that question. We can connect you. Where a lot of people go to is Van City, who has a product called the Mixer Mortgage. And Ryan McKinley is someone there who really gets it. I think, Richard, you had a call out to Van City earlier. So that would be a place to start, but there certainly are mortgage brokers and other options that we can connect you to as well. Betty asks, what is the best way to breach the subject of a multi-generational project with the family patriarch to show them the value of investing in their family stability through property ownership and the benefits that they too may derive from such an entangled relationship? Great question. I certainly, I and the other coho members are available to kind of be here to explain and give confidence to potential partners and family members about the co-ownership pathway, and we can set up personalized calls. But Richard, or Mark, I'll turn these over to you. How people, especially older people, tend to be a little bit skeptical about this model. How do you breach this and get them to see its potential?
Yeah, I'll start. So I deal with this quite a lot, not so much with co-ownership, but often business succession planning. And be it the patriarch or the matriarch, often what I've found is the matriarch is actually the person in control of a lot of these big decisions in a traditional sort of a family. So what I found, just when you speak to the patriarch, you really got to win over the matriarch, because often that's where the decision making happens. And then something, it has to do with empathy. Often whoever's in charge, the decision maker, will have their own ideas of how things will play out. And then you do the exact same thing of the what if situations, like how is this going to play out? What happens if things don't go according to plan? How do you help out the kids the best way? Because essentially succession planning is not just about money succession. It's about how to keep the family tight and not lose family members, a little bit of it, reducing the infighting, possibility of infighting. So I imagine it's something similar with this. If someone like Richard has this idea of how he wants to do this succession planning and using real estate, I imagine you would need a gameplay, how to make it sure it's equitable, everyone gets their fair share, and sort of go down from there. So that's sort of my experience with succession.
So I have to smile as Mark said, with commenting. I go, so Mom, what would Dad think about if we were to do this idea of a multi-generational? Yeah, Mom controls the show. And guess what? It was my wife said, Richard, I remember it was a Monday of a September long weekend. Here's what I think we should do, Richard. And I looked at her and said, yeah, it's a great idea. And she said, what did you say? Did you just agree with me? So I will give you a heads up. I take care of my 95-year-old mother, and 8:30 is a magic time for us to make sure she's settled into her bed. So I will be exiting. No, feel free to share my office email address with everyone. And for people that have questions, don't hesitate to reach out to me if we don't in the next sort of short while get any specific Bell Alliance questions. Anyway, so I will stand by for the next 5 minutes and then disappear to how Mom's doing.
Fantastic. Well, thank you. Yeah, and I'm going to start to wrap this up. There were some questions about what will come after the fact. So there were some technical issues. Looked like there was a bad link in one of the emails that came out to people. So some folks missed today's session. There will be a follow-up email sent out tomorrow, which will have Richard, Mark, and Steven's contact information to get in touch with them directly, as well as mine, Brian's, and David's to get in touch with us about your needs, and a link to this session. So if people want to rewatch this session or forward it to a friend or anyone who registered and missed it, they will be getting a copy of the link, and we will send out everyone's contact information. So look for that email. If you don't see it, again, reach out to us to say for some reason it went into my spam folder. There's a lot happening at Coho in general, and I'm not going to spend much time on this stuff, but we have some co-investment opportunities. Clearly, so does Addy, that people can get involved with. We have people who are looking to sell shares in their properties, looking for co-owners. Most people are generally seeking end users, at least that's their assumption. But these could be great opportunities for an investor as well to come in and then rent out the portion of this property. So this is a property that Brian has listed outside of Parksville on Vancouver Island This is a collective home that I'm helping them find a new partner with in Kamloops. A half a house for sale. This is a great investment property because it's a 3-suited large lot property in East Vancouver. So it would really work well as a rental or as a home, but with the knowledge that you're getting rental income from the basement suite because it's a two owners stake of a 3-suited home and on a large lot with future potential. Brian has another partial share of a property on Gabriola. So we got some interesting stuff going on. The Coho website, please do check that out for resources, especially if you're new here, about how co-ownership works. If you're looking for a housing partner, fill out our housing survey and check out our classifieds, where we have people looking for partners. Again, through the Coho community, where most people are looking for end user partners. But if someone were to come along and say, you know, I'll be an investor partner with you, I think that could be a nice magic bullet as well. There actually are some interesting platforms in Ontario and other countries now where people can just invest money into people's homes, single family homes. A group in Ontario called Arboro and others. If any of you here have some deep pocketbooks and want to set up something similar where we can invest in the housing of people in Vancouver, we'd love to help facilitate that. So there's a lot of possibilities to how we can help you, or you can if you're looking to invest, you can help many of our end users who are looking for pathways. We have a bunch of events coming up. Oh, I thought I updated this one. I had today on here, sorry, but there's events coming up in the next month, November and December, a shareable homes tour in East Vancouver, our info session I mentioned on November 20th, and our matchmaking event on December 11th. So check out our website for how to register for those events. And we are at that 1.5 hour magic point. So I will officially thank everybody for coming. A big thank you to our presenters. And there are still a couple more questions in the chat. So people who can stick around. We'll address those, but we'll let Richard go take care of his mother. And encourage folks to then visit our website, follow up with emails. You'll get again Mark, Stephen, and Richard's infos in an email. And we hope to see you more in the Coho community. So thank you everybody for coming. And if you're able to stick around, we'll answer a few more of those outstanding questions. So I mean, the outstanding questions I see here, actually, unless I'm missing some, have to do with the rezoning and the city government and the government policy about multiplexes. Is stratification legislation coming to the Gulf Islands? What about non-municipalities like Salt Spring? And the answer, as far as I know, we've lost Richard, but is a little bit of yes and no. The focus on the government is on these higher density or locations that really have the majority of the housing crunch, although the smaller communities, we've seen a huge housing crunch on the Gulf Islands as well. So as of now, though, they haven't been the pressures have been on the larger municipalities. But Brian, maybe you can talk to this. There's definitely a push in some of these smaller municipalities to allow a little more kind of creative use of land, a policy to not kick tiny home dwellers and multi-suites off their property, and to acknowledge that there is a housing crisis. So Brian, do you have an answer to this question?
Well, yeah, there's definite acknowledgement, and our municipalities in these more rural types of settings are looking for solutions and really looking towards co-ownership and how it can not be the solution, but help. But when it comes to developing and increasing density, it seems the municipalities want to tie into city services. So when it comes down to, getting more density, they really are pushing going up as opposed to out, where there's water, access to municipal water and access to sewage. So that's a big part of it. But there is also more leniency for even if, for example, Gulf Islands Trust, they're not kicking people out of their unauthorized tiny homes if they have access to clean drinking water. and are managing their gray water and waste responsibly. So that to me is a real future. If we can prove to our municipalities that we can increase density in rural settings beyond what the zoning says, but prove to our municipalities that everyone's living responsibly and there's access to water and the waste is being managed responsibly, that maybe more jurisdictions will have standing resolutions in place similar to what the Gulf Islands Trust has, which will provide a lot more security for people living in these unauthorized dwellings. And hopefully in the future, they won't be considered unauthorized. But that's typically what's happening right now. It all comes down to water and waste. And what I'm seeing here in Cowichan Valley and other areas is developing the urban cores. And what I'm focusing on as far as increasing density in rural areas is the co-ownership aspect, because there's many properties that are zoned for 2 dwellings. And most of these properties are owned by one party. So there's a huge demand and a lot of opportunity to expand the forms of ownership and increasing density at a smaller level in our rural settings.
And one last comment here, and I think that's pretty much everything we have on the chat, is that the increased density is a great initiative, but basically, what about parking? And certainly, you know, municipalities need to keep in mind all the parts of livability that make a city. So I know there are some parking considerations going into this planning, and clearly this needs to be done in combination with a push for better transit and better car sharing options and better bike lanes and more livable 15-minute cities. So hopefully all of that is going into the urban planning as these models unfold. So unless there are any other outstanding questions or comments, anyone else want to say anything as we close? Then once again, I'll thank Stephen, and I will thank Richard, who's moved on, and I will thank Mark for being with us here this evening and for being pioneers in this field, whether it be on a large scale with a big tech startup or just by doing it yourself and letting everyone know about your experience. And encourage folks to stay involved, stay connected, and follow up so we can help get you set up successfully, either in a home or in an investment or whatever makes sense for you. Thank you, everybody, and have a good night.
Bye, everyone.